Good afternoon. It's Tuesday, February 19th, Season 1, Episode 5. Stratton Mortgage here again. Hopefully people are turning into this and taking something from it here. I'm Tom Christie.
Bill Seach.
Trey Reedy.
Adam Baumline.
Today, we're going to go over three topics. Owning a rental property. How or when is it time to refinance? And then self-employment income. With those three topics, a lot of questions will be surrounding these, and they are all very important. Starting off here with owning a rental property. Bill, do you want to start off with some information about that?
Sure. I saw, I was reading online and I saw a question. I found my dream home, but I wasn't ready to move yet, or I didn't sell or have my other house in contract and things like that. And I think that's where we want to go with this a little bit. I just did a deal where they were buying a new home. It was $400,000. Their current home was $200,000, but it wasn't in contract. So, in that case, our lender that we have is and it may be more than one, but they'll let you just go off of the 1007, I think the form is.
Yeah, there's a rent form that you can get conforming or even lease agreement.
So you can still buy the other house and just keep the other one as your current house as a rental, right?
Yep, with some reserve requirements, but yeah, you can do it. Yeah.
And you don't require a huge down payment. I mean, obviously, most people will take that equity out of that house and put it in the new house, but if you have 3% down, you could still do that, right?
Yeah.
Well, that's if they're moving from. That's if you're making your present home.
Yeah. So
your rental. That's one option. Yeah.
Yeah, and I see what you're saying, Bill. Just how do you get into that next house if I don't have a contract? And a lot of people's concerns that personally I have found is, well, I feel like if I want to own a rental home, I'd like to have one, but I've never had a rental before. I've been told I need to have a rental and have rental income on my tax returns in order to qualify to own a rental home. That's not the case.
Right.
And I've ran into that numerous times. Or, well, I have to have certain loan to value on my current residence in order to convert it into a rental property. Or I need to change the current loan into a particular loan to be considered a rental. And then, again, those are all not true. At least on our side, that is. A scenario I ran into, a gentleman I helped in Colorado was trying to buy another primary residence, and he wanted to keep his two, and he was told by local lenders, you can't do it. You've never owned a rental before. You don't have enough loan to value in here, so he couldn't get it. He called me. All we had to do was provide lease agreements in this particular case here to prove that he had those units rented out already. We took that income, and you're able to use 75% of what your rental income is. So for simple numbers, if you're getting $1,000 a month in rent, you only get credit for $750. Most cases that will wash that payment out and allow you to move into that new home and still qualify for that house. So now you've picked up another form of investment with being invested into real estate, letting somebody else pay for that asset for you while you have moved on and upgraded your home style or your needs that you're looking to move into. I talk to you guys about this all the time. It's no different than somebody walking to you and asking to pay into your 401k. And that's essentially what you're getting when you can rent a house out. Again, the math needs to make sense.
Sure.
If your payment is $800 a month and your area is collecting $1,300 a month on average of rent, why would you not let somebody pay that mortgage for you each and every single month while you're living in your new house?
And to clarify, you're allowed to have, some lenders let us have 4, some let us have 5, some of you let us have 10 houses at one time.
Credit score restrictions. The one I'm dealing with right now, you have to have at least a 740 score to have over 6 properties as being considered financed.
That's financed, right, with a loan on them.
That's another level of investing, and that's a big leap, but you got to start somewhere. And that I think a lot of people's confusion arises is, well, I'd love to own a rental home, but just don't know how to go about doing it.
Right.
And that starter home is the perfect conversion for a rental in most cases. And again, it's somebody else just paying that asset down for you. So when you turn to sell it, you're reaping that capital gain from somebody else paying that mortgage down for you. All the while, you've been living in your primary residence.
That's actually something I'm trying to convince my wife to do, is because we have a condo and our mortgage is $700, and the average rent on our street at least is anywhere from $1,200 to $1,500. and
Yeah.
it just makes
You
And
can-
with,
yeah.
with no prepayment penalties on these, you can you can have an additional X amount of $100 going to paying that balance down if you don't need to keep that residual income, or you can. Again, everybody's situation is different, but again, you can really accelerate paying that balance down by letting that renter pay that entire payment with all that extra rent that you collect to be going towards paying that principal down.
So you can. So another option too is, we had an investor fly in a couple weeks ago from Vegas. So they're investing a lot in the Columbus market. In fact, one of the reps I talked to up in Cleveland said the same thing up there too. So a lot of people are investing. There are programs out there that are not just for a real estate, quote unquote property flipper or investor. So they call it the debt service coverage ratio program, where essentially, if you're going to you need to have 20% down to purchase a rental property. In some cases, 15%, but realistically, 20%.
Well, that's if you're going just to straight up buy a rental property. So
Correct. Yeah, if you're just going to straight
you
out
own a
go buy
house,
one, you own it, and you see a good deal and you want to buy it. So they have a program, and again, using simple numbers here, let's assume that the mortgage payment is $1,000 a month. As long as the market rent for the area is $800 a month for that property, you have 20% down. That's all they're looking at. You can purchase that property as a rental property.
The ratios don't come into play.
The ratios do not come into play. They're looking at the
asset.
appraiser. The appraiser is looking at what the market rents would be to determine that. So, if somebody feels like there's a barrier of entry, if you will, like you said, like they've never owned a property before, so they don't have, how do I get rental history if I can't get rental history? Mm-hmm. Well, this is one avenue. Maybe you're self-employed, or there are varying reasons. You have a lot of student loans where you don't qualify. Like even with the rent, you can't qualify for a regular conventional loan for the investment property, but you have the money. You can still do this alternative, option, and you're still getting a good market rent, which is paying down your loan. You're not making that payment. Essentially somebody else is creating equity in your investment, which you then realize when you sell the property, or some people use that as a cash flow. It's paid off, and hey, I'm retired and I own 10 or 12 properties that are free and clear. I'm making 5, 10, 15,000, whatever that number is.
collecting rent.
That's passive income that they're getting. So more people are doing that, and they're trying to do that quickly. And so that's a program where somebody can step into that market,
Right.
very quickly, get a property.
Just to clarify, though, going back to Trey's situation, his mortgage payment's $700 right now, and let's say he finds a house that's worth $200,000. Well, we have a 1% down program. We have a 3% down program. He can go and buy that house for 1% down, just using the rent schedule for
His current
house.
Yeah, to offset
So people think that they need 20% down to buy that bigger house, but they don't.
Yeah,
Correct.
that's
Do
true
not.
too. Yeah, and then they can create the conversion of the primary
Right.
into a rental. Or I have two people right now. One's purchasing a home up north. The other people are from California purchasing an investment property here. They're just purchasing it straight out. They have other investment properties. For this new one, we're using the rental income on the new one to offset the mortgage payment to help them to qualify, because they own several properties and they're still getting a conventional loan. So
Did the bank have?
Most people can't afford to they don't make enough money per month. And again, there's a small percentage of people that can say, I can afford to take on all these payments and have no money coming in. And that's, I think, where the confusion, where people are trying to buy a house is, well, how am I going to qualify to buy this house? Because I have a mortgage payment here, and I'm going to buy this house. I'm going to have a mortgage payment here. And that's
I don't qualify for two mortgages.
Yeah.
Well, the rental income is helping you to offset
Exactly.
that.
Did they give you any? Did the lender give you any problem with living in California and buying a house here?
No.
Not at all.
No, yeah.
Okay.
Well, it's an investment property, so no.
Okay.
Hey, we're buying in the two scenarios that I have. Actually, both are duplexes, and they're leased out. So somebody's coming in and saying, "Hey, I want to take over this property," trying to invest in what they feel are up and coming areas.
Okay.
Another asset.
Which and they already own several properties. I mean, with their income, if you didn't use any of the rental income on it, they wouldn't qualify. Because I think the one couple owns 4 or 5 properties.
Gotcha.
So you got to think they got 4 or 5 mortgages on their credit, plus car loans, student loans, other things that in general people
Cost
are
of
going to
living.
have.
Even if you're a surgeon, you ought to be able to afford
Yeah,
that.
like they're not. They need that rental income to help offset it.
Sure.
But you can tell that their mindset is, hey, I am using somebody else is paying down that mortgage to create equity in my asset that I'm that I'm not necessarily doing.
Sounds like common sense lending's coming back a little bit. In
A
the
little bit,
subprime world,
yeah,
you know,
a little bit. Some of those programs require, you got to think you want to have some reserves in that. Obviously, owning a rental property,
That's a good question.
you're the
How many months
you're
of
the
reserves do you
landlord.
need for that?
It varies whether it's Fannie or Freddie in terms of how many.
Yeah.
Some go off the payment and how much you have. Then the portfolio products or the non-QM ones, some of them don't really have a reserve.
Okay.
Typical rule of thumb's like 6 months
y-
of payments of principal.
You might want to
interest,
have
and-
something because
And most people, most people have a 401k today, and it doesn't mean you need to draw on it, but it shows that you have a reserve. That if something happened, you can always get a 401k. There's your reserve. As long as you have enough to cover 6 months that's sitting in a 401k, they will consider that a reserve. You got to provide documentations of what it would be to withdraw that, but that's easy enough to get. It doesn't mean it needs to be sitting in your checking or savings account. Basically.
yeah, they just want to see, because you got to think you own that that's you're the owner of that property. So if it needs a new roof, if it needs a refrigerator, new carpet, something like that.
Renter in there for 6 months.
Yeah.
How is that payment going to be made?
We've got to repaint our rental property. Just moved out, and over time,
You have
walls get dinged up, whatever, and you want to make it nice for the new people. So there is a cost associated with that, but in a long-term investment strategy, they're still paying down your loan to where most people wouldn't have the financial resources to be able to do that. And if somebody else can pay it down for you, why would you want to pay it? Why would you not have them pay it? So it's a nice, a lot of people are do and you sell it down the road, or whatever if you want the rental, whatever. I mean, everybody's, like you said, everybody's different, but we are seeing a lot of that. I mean, we have collectively right here between 3 or 4 loan officers in 1 month, we've got 6 or 7 rental properties just in Ohio. So imagine,
Right.
it's happening.
Other companies, other lenders, other states around the country. I mean, it's
especially where rates are low. I mean, if you can get a much cheaper payment, rents are going up in Columbus anyways. I mean, that's a statistic you can look online. We're one of the biggest appreciating cities for rent. Not the most expensive, but the biggest jump in rents. It's getting more expensive to live in Columbus. Whether that's housing market's going up and rents are going up, which get in because people are always going to need to rent or need a place to stay. But let them pay your asset down for you.
good or bad, it's happening, and that's what's going on right now. And it's just
Be a part
the
of
market shifts. It can vary and go the other way, but right now in Central Ohio, that's what's happening, and that's probably what's drawing the investors here, or people wanting to get down there in those markets because it is a good opportunity, and people are creating wealth and equity for themselves. So
It's like if you had a crystal ball, how many of us would go back and buy that house that today is worth $175,000 for $100,000? When the
there's
crash
so
happened?
many of them in
Imagine
around
what you could
downtown.
have
Oh my
today.
gosh,
I mean, again, it's if you
man.
ask the right questions, do the research, and the math will show you what's out there. Does anybody else have anything else to hit on that part of it there?
I think that's good. I think it's a good start. Obviously, if somebody has questions about that or wants to learn more, or even if they're a seasoned investor, you've got several seasoned investors you work with. We've got some people coming on board, some other seasoned people that we work with. We can answer questions for us. Just reach out to us. We'd be glad to provide information on that, see if it makes sense, see if it's something you want to do. Worst case scenario, you get a bunch of good information and you've got a plan. Maybe now is not the right time, but maybe it's you want to do it. Okay, well, let's help you get on a plan so that next year or 2 years or whatever that time frame is, you're ready to go, at that time.
So you wouldn't jump into a 10-foot pool never having swam before?
I tried it one time. Didn't pan out well.
Yeah. So topic 2, we thought to be really important here, and we've been finding a lot of questions, again, with the treasury market down and rates low. When is the right time to do a refinance? I've had some people that, I just bought a house a year ago. It's not the right time. Well, if you don't look at the math, how do you know? I mean, what if there's a chance to take yourself from a 29-year fixed to a 25-year fixed and keep your payment the same? So when is the right time to do a refinance? When should somebody start calling and asking questions?
There's several factors, but what we say this, I know Tom says a lot, and I say it too. The math, the numbers are not going to lie. The math has to make sense. So I have recently, and I have another one, people who purchased a home last year with less money down. Credit scores are a little bit lower. They weren't bad, but now credit scores have increased. They've created some equity in the property. They've paid it down. The property's increased a little bit. And interest rates recently went down with the little rate war with one of the lenders. So in both of those scenarios, we were able to have almost all of their costs covered, I think with the exception of like $900. All of their costs were covered. They either got a free appraisal or didn't need to get an appraisal, and moved their interest rate down to 0.5% on their loan, which essentially is only 6 to 8 months old. In both of those cases, they chose to go back to 30 years, but they actually could have moved up to a 28 or 27-year loan and had the exact same payment.
Hold on, you just said 27-year fixed rate loan. There is such a thing then.
Yeah, we can set a yearly term. You don't have to do 30 years or 20 years or 15 years. We can do 12, 22, 28, 27. So we can tailor that around to make the best benefit for that person, depending on what's going on, like you did with the other customer.
Customize your own mortgage.
Yeah, you kind of customize a little bit what's important to you. In my two particular cases, the loan was so brand new. Hey, I think they saved close to $100 a month. Didn't cost them anything. Now, in both of those scenarios, in fact, the one of the borrowers was actually paid ahead a month. Going to continue to do that. Now they got an extra $100 a month to pay towards their principal, which is just going to accelerate their loan even faster and pay it down even quicker and create more equity for them even faster by simply taking advantage of a law in the marketplace when rates go down.
Paying attention and asking questions. They knew to reach out to Adam and just look at the math, and that's exactly what he did. The math, he showed it. Hey, here it is. Well, why would we not do this? Again, it's $100, and they'd only been in it for 6 months. It was
like literally brand new. And the one refinance, literally, I'm not joking. I talked to her on Thursday. In fact, we were just doing a check-in, and come to find out that her scores had gone up quite a bit. Friday, we locked her interest rate, submitted loan application to her via e-signature, electronically verified her income, electronically verified her assets, got an appraisal waiver. She signed everything on Friday. This morning, she came out of underwriting needing her title work and a driver's license. So technically, you can't get the title work back that fast, but she would be clear to close. She couldn't even close. She'd be clear to close in 2 days. She couldn't even legally close because we haven't met the minimum mandatory time.
Oh, there was a big holiday in there
for the disclosures. Yeah, and yesterday was President's Day, which doesn't even count as a business day, but the lender was working. So,
well, it has a lot to do with you stacking the deal and doing it the right way too. If you get it all in the beginning, what happens?
A little bit. Well, in that case, it was just taking advantage of the digital world that we have access to and making it easier. Literally, she spent probably 15 minutes maybe at the most. And 10 minutes of that is us talking, going over what's going to happen, what does she want to do, stuff like that. So.
No, but I got one. Same thing. His two options, we closed them a year ago, and his two options are refinance now and save $115 a month back to the 30, or go to 25 years and have a $4 more payment than he has now. So what would you do? You know what I mean?
Well, actually,
so you're cutting out 4 years of payments at $1,200 a month.
Okay, let's just say it's $1,000. Just to round simple numbers. That's $48,000 of less interest paid
over 4 years. Right.
Over 4 years, yeah. So again, how do you?
Well, the other refinance I have right now, he moved from FHA to conventional.
That's the big one there.
Down to a 20-year loan. His payment went up $30 a month, but he moved ahead 8 years on his loan, which
Wow.
I think we calculated it somewhere in the neighborhood of about $60,000. And in his case, they're not, as far as they want to stay there. That's they've had their child there. They're having another child there. That's where they want to live. So he even went as far as buying down the interest rate, paid 1 point to buy it down because he's going to be there for more than 5 years. He's not going anywhere.
Right.
I mean, he's literally saving. In fact, he's just gave some props today in the networking group, but that's a massive amount of savings for him. And he's on a 20. I mean, he's going to pay his loan down faster if he does go and sell in the future. He's created more equity that he's going to realize when he goes to sell.
Without a doubt.
So that's a big one too. Just because you're on an FHA loan, maybe your interest rate is going to go up a little bit, but you're getting rid of the FHA mortgage insurance, which is very expensive.
Yes.
Yeah, and now and we can show you we can show you the math, we can show you the amortization schedule. The numbers don't lie. It either makes sense or it doesn't, and we're going to know very quickly whether or not it makes sense. And then we say, hey, here's the numbers.
Yeah.
Hey, Steve, it's not the right time to do it. But the customer knows, right? Now they know what's going on. So, or Joe, or Tim, whoever, Andrea.
Go from FHA to conventional, and FHA's rates are lower. But that's, again, when you factor in that mortgage insurance, and everything else that goes into FHA, when you send your mortgage payment in, no one's ever written their interest rate or what type of loan they have on that check. It's a dollars and cents that you write on that check. So that would be the most important thing when you send out. I mean, you could have a 1% rate, and if your payment's $5,000, but I have a 4% rate here, and your payment's $2,000. I mean, you're not writing the rate on there. So take the payment. It's less over the term.
You got to figure out what you're trying to do. But
yeah. But to your point, I had an FHA client that had a really low FHA rate, and I did the math and found that a conventional loan was a much better option for her. And she couldn't fathom the fact that her rate was going up as much as it did. So when I broke it down, I said, well, look, here's your payment. Your rate's going up, but when you get rid of this mortgage insurance that FHA has, it was huge savings. And now that's been 7 years ago that I did that. It's one of my wife's really good friends, and to this day, she's getting ready to sell that house, and she has thanked me 100 times over because it is tens of thousands of dollars that she saved. Well, not saved, but she's getting back now in the capital gain that she would have rather not had. When you sell a house, you're going to pay a realtor cost. So how do you offset that realtor cost? And when you list your home, you start seeing all these costs that are associated with trying to sell. Well, if you can navigate your asset appropriately and monitor it, and that's what we're here to do to help do, is show you different ideas and strategies that could really put you in a better position for when that time does come to sell, where it's, well, you've just made the right move to where all the cost that goes to sell is a moot point now.
Right.
And that's paying attention to your asset. It's not a car you're buying. This is the largest investment you're ever going to make in most cases, at least for people like me anyways.
Well, and most people think, what's the lowest payment I can get when they're buying a house, but if you have a little bit of money saved away and you're good with money, this is what we're talking about. Cut it to 25 years. It saves you $50,000 over the life of the loan. I mean, who wouldn't want to do that, right?
But you don't even need to have money in those cases to do that. If you've been at 30-year fix and you've got your mindset to making an X amount of dollars per month, and that's what you've kind of, I guess, programmed yourself to be, then we can keep that program the same, but let's go ahead and now start moving money away from interest and now towards principal, so that when you do sell that home, bigger capital gain for you. Again, the ultimate goal is if you could retire and liquidate, you've bought 3 rental properties that you let somebody else pay down, you've navigated your asset and hedged funds down here to get a lower payoff when time comes to retire. You get all these funds coming in from when you want to liquidate to retire, and then you have your retirement on the side as well, your pension 401k. It's a much bigger number now and a much easier pill to swallow when you want to be done working at 65 or whatever.
And people, they really don't understand, because the same person will say, maybe not about that deal. We'll drive 2 miles to get an extra dime off of gas or something like that.
Funny.
You know what I mean?
I've told that. I've used that story a lot, and everybody laughs because I've done that. They save $2
right.
to go down the street, where here you don't even have to drive anywhere. It's
right.
really that simple. I'm just explaining how easy the one he did. And again, not all are going to be that easy, but again, when you see it all, And again, either makes sense or it doesn't. There's not one person sitting at this table that would say 1 + 1 = 3. I mean, where's our credibility? We've all been doing this way too long to do anything like that.
One thing we'll touch on this in another podcast, but we sit here weekly and talk about how quickly or how easily we're getting things done. A lot of that has to do with the preparation work that we're doing up front. Mm-hmm. So if that's not being done, the process can be a lot more difficult for a buyer or something like that. So we'll maybe next week we can touch on
point you make, 'cause it's
what are we doing?
Front,
right? How are we preparing the customers up front? What are we doing? What is that time frame? Because sometimes some of these people, we've talked to them a year ago or more.
Yeah.
And we had to do something or prepare or whatever, or they're 3 months out. We're telling the agents, hey, it's okay if they're not buying a home until the end of summer. We need to talk to them now.
Yeah.
Because we need to make sure they're ready to go. Now they're ready to go. When they're submitting an offer, they know what their payment is. They know what their loan is going to be, how much money you have to bring to closing. They're ready to go. So we can
hit the ground running.
Yeah,
everybody knows who Peyton Manning is. I mean, my wife knows who Peyton Manning is. That guy never went to a single football game without watching
not
tape
being unprepared.
Being
he's
prepared.
prepared.
That's why he's one of the greatest in the world, is because of being prepared.
Yeah.
Again, your biggest investment you're ever going to make, prepare for it.
Yeah.
Don't jump off that high dive having never swam before.
Yeah, we'll talk about that next week, about what we do, how we do it, what we ask, what we recommend we do, or how we and stuff like that. So that's an important point, because sometimes people will think, well, geez, everything they're doing, oh man, everything's so easy. Well, there's a lot of we are making it easy, but there's a lot of back end work that we're doing.
That's a good point.
To get to that point.
And that actually brings you right to the next topic, the self-employed borrower. Are they prepared when they're coming to our office? Because I just had one where, he had 2 businesses going at the same time. He filed a K-1 in 2017, switched to a W-2 in 2018, or I'm sorry, 16 to 17, he switched. So then I couldn't use the 2 years of their income. Okay, so the third, I had to make him file his 2018 return so that I could average the 2 years for 17 and 18. But it's all preparation, and business tax returns. You need both the businesses. You need
everything. If there's K-1s, if there's if you're W-2s, if it's how it's flowing through to the personal return. There's So the biggest thing with self-employed, I think, in us is number one, we know how to calculate it. We've got the forms to do it, but we also, in general, like to have underwriting review those and give us that number
prior to shopping,
right? So that we have that number, because really, for the most part, whether it's conventional loan, FHA, VA, and really even USDA, it's an automated underwriting system. Mm-hmm. So you can punch in any information you want to punch in there. If I say the borrower makes $75,000 a month and they're approved, but they only make $7,500.
Yeah, now verify that.
Now it's verified. Then bad information in is bad information out. So if you're looking at a self-employed borrower and you're not calculating those details correctly up front, then number one, they may not qualify. Number two, now you're trying to do that during most likely a 30-day contract, because that's or less potentially. That's a lot on somebody to try and have to figure all that out and get it done and jump through the hoops, on top of work, life, if you've got kids, if you've got extracurricular activities. That's a lot that's going on. Mm-hmm. If you get those things done ahead of time,
what to expect.
I haven't had any customer to this point tell me, geez, I really wish I'm glad I didn't do anything up front. And I mean, it's like, it doesn't, it makes things so much easier, and our preparation on that makes a difference. And if we need to, being able to send it to underwriting, get that full approval up front with their income, or have an underwriter review the income, know what it's going to be. That way, when we're pre-qualifying, it's accurate. Now we can't force somebody to send their information in. If they refuse to do that, they refuse to do it. But that's what's going to lead to problems down the road. And really, if you think about it in general, any loans that we've had that have headaches or problems or whatever, in general, it's we were not able, or they were unwilling to give the information up front, or whatever. We gathered as much as we possibly could,
or they were willing to give.
And then now you're jumping through hurdles during the process, which makes it a pain, which you don't want to do. It's harder for them. It's harder for us. It's harder for the agents. There's a lot going on. So.
Yeah, and like you said, just not creating more unneeded efforts from them. They have a life. They have things to do. So knowing what we're dealing with on self-employed, there's a difference between Fannie Mae and Freddie Mac when it comes to self-employed businesses and self-employed owners. It's, do you want to go through all these documents in 2 years, returns of taxes, and when somebody may have differences in income, well, maybe they've been in business for 10 years. Well, the smart thing would do would be go through the avenue of the least path of resistance and let's provide 1 year. And some people are like, well, how are you going to do that? Well, again, we know what we're doing. We don't want to create.
Yeah, there are potential options there, on that. Or what if they get? I mean, I had the one borrower had 3 businesses, so I had 6 sets of tax returns. It was like a ream of paper on my desk. Mm-hmm. That's a lot to go through and figure out. It needed to be done up front because we didn't, with rental properties as well too, with leases, with purchasing and acquiring properties and all sorts of stuff going on. It's like kind of like trying to hit a moving target. So you need to, you need to do that stuff up front. So
okay. And that 1 year thing you're talking about, Tom, that was for the Freddie side?
Yeah, Freddie will, as long as you've been in business, I believe, is it 5 years?
Sure,
you've
5
had a
years.
business license for 5 years, then they only need to see 1 year tax returns versus Fannie's 2 years.
Right,
schedules.
The reason mine's off because it was a specialty. It's a jumbo product. That's why.
Okay.
So that's kind of the difference there. But
but that's back to Adam's point. Be prepared up front. That way we can get you in the best position to hit the ground running. We will help you get to that point so that this is not a nuisance. It's supposed to be an exciting time. And that's what we want to try to create.
That's key. Yeah.
Nothing better than having a clear to close a week in advance.
Right?
Or more.
Clear to close. And
right.
Like you said, knowing like my closing date's not for another week. Right. I have a loan closing next week that we're a week and a half ahead of schedule. And both realtors like, what? How did this even happen?
Right.
But again, I was able to work with the girl 3 months in advance. So she knew exactly what we needed to do, what we were going to get done. I went over everything. So as soon as that contract was executed, boom, we were off and running. I've talked to her maybe twice, and she's going to be closing on Monday.
Nice.
So it's
nice.
And again, that was all because of the conversations we had up front. On her.
But that also makes it easy on once we get them approved. There's not that many conditions that are on there, if any, and so it makes it very easy for loan managers, processors to help us out, get those items. It's very efficient and effective.
Most people would be nervous if you knew that your client just went into a contract and they just went to Florida for 2 weeks. They'd be like, no, what? And she was in Florida for 2 weeks, and we didn't talk to her one time. So she got to enjoy her vacation, do her life, and we got the loan done.
Being prepared.
Nice.
Yep.
All right. Well, I think that wraps it up for today, guys. What do you think? You got anything else today?
No, I think that'll do it.
No,
Right?
I think we had some pretty good topics today.
Okay.
Well, remember,
that's a really cool shirt, by the way.
You like that? Like us on like us on Facebook, follow us on Facebook, Instagram.
Check out our website.
Yeah, we check out the website.
Look at our reviews.
Yeah, check out the reviews. We got the podcast going up. So
yeah, even if people just want to bounce ideas around, I mean, as you could hear, we all have them. There's a lot of things that this is what we do. We don't try to figure out if Bill has a cavity, he's going to go to a dentist. We don't want to figure that out. So call if you have questions, call us. Anything you might be thinking of, we can give you some suggestions and ideas to ponder over, and maybe put you down a path of prosperity and real estate investments.
All right.
Excellent.
Cool.
Have a good day.
Have a good day.
Yep.